I recently watched a video from another financial YouTuber that I follow who has hundreds of thousands of subscribers, and I was triggered. I'm not here to cause any drama, so I won't mention his channel, especially since it's an investing channel with great content. He is a value investor investing in mega cap stocks that pay dividends like Apple, Coca-Cola, Visa, and Disney, which is a very easy and safe way for long-term investing. However, he was very pompous and belittled high-growth stocks, laughing at companies like Palantir, Tattooed Chef, and Fubo TV. Those are the type of stocks I like to invest in, so he had my gears turning. I respect and acknowledge his investing outlook in the financial markets, especially being a sharp guy, but I think that the video was completely unnecessary and was surprised at his outlook. My biggest issue with the video was that he never gave the pros and cons or acknowledged both sides of the story. He seemed to only favor what he was doing as the only way of life and continued on a rampage. So here we are now. It gave me a great video idea to defend high growth stocks as a whole. In this video, I will go over the pros and cons of both long-term investing approaches. If you're not sure as to whether to invest in value stocks, high growth stocks, or both, you don't want to miss this. If you enjoyed this video, make sure to like, subscribe, and hit the bell to get notified for my latest videos. If you want to get 2 free stocks, try Webull. Get 2 free stocks when you deposit $100 or more. To get the most up-to-date high growth stock news, my latest buy and sell alerts, and smart money market sentiment, check out my Patreon. It comes with private Discord and a full range of server benefits. All the links will be below under the description of this video. Let's start off by defining what a growth stock is first. A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks generally do not pay dividends. This is because the issuers of growth stocks are usually companies that want to reinvest any earnings they accrue in order to accelerate growth in the short term. When investors invest in growth stocks, they anticipate that they will earn money through capital gains when they eventually sell their shares in the future. Now let's go see what value stocks are. A value stock refers to shares of a company that appears to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. In short, growth stocks are usually smaller companies trading at high price to earnings ratio that typically don't pay dividends, and investors anticipate that they will earn money through capital gains when they eventually sell their shares in the future. It's not all peaches and cream. Some of the risk of high growth stocks is a high volatility. You can expect constant abnormal moves both to the up and downside in any given year. You need a strong stomach to be able to deal with the short-term swings. Another risk is choosing the right high growth stock company. Most of the time, these are very young companies that haven't been proven in a successful business model, and most of the time, the investment is a speculative position. That's the biggest gamble. In other words, high growth stocks equate to high risk, but high reward potential. The advantages of investing in value stocks is that most of the time these are matured, proven companies trading at fair valuations and paying dividends to compensate their investors. These tend to be low volatile stocks with safe, predictable, reasonable, long-term positive returns. The disadvantage in large cap value stocks is the low yearly returns in contrast to high growth stocks. Value stocks are not exciting to most small investors or those trying to maximize smaller accounts. I found this video from Warren Buffett and Charlie Munger giving their point of view on the matter, which I thought it was fantastic. Let's take a look.
Actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to growth usually is a positive for value, but only when it means that by adding capital now you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case again is the airline business. The airline business has been a growth business ever since that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public, but the growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is part of the equation, but anybody that tells you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock, who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
Warren Buffett slams Wall Street by saying they are wrong for separating these two terms in two different investing points of views. He explains how growth and value are both metrics that can be found on a single stock. He says these are not two different categories, giving great examples. How about that for a monkey wrench? For the simplicity of this video, I will refer to myself as a high growth stock investor. As for the YouTube channel that triggered this video, I will categorize him as a value investor. So which investing style is the best? Which investing style is the most profitable? Before I personally address these questions, I want to play this next video from Warren Buffett and Charlie Munger.
My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow per year, something like that. But I was working with a tiny amount of money, and so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap, and obviously as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
He says that if he was investing with a small amount of money, the universe would be huge compared to the universe of possible ideas he's able to work with now. He would concentrate his investment into one or two great obscure stock opportunities. As the money grows, the curve of expected results decreases dramatically. I think this was an amazing video. There's a lot more behind the things they actually said. What they are saying is that if you have a small amount of money, you need to concentrate that money into one or two positions. Obviously, do your homework and not just pick any low price stock at random. I like to invest in small to medium cap high growth stocks, and I like to go big in those positions. In my biggest broker account, I only concentrate my portfolio into 1 to 3 stocks. I have a very small account under the eyes of Wall Street, and that account, it fluctuates between tens of thousands of dollars to hundreds of thousands of dollars. I haven't passed $250,000 at any given time, just to give an idea. I only buy SPACs and stocks that have recently IPO'd. I'm investing in these speculative risky stocks that make sense to me based on my research, expecting these smaller or startup companies to become the value stocks of the future, which then Wall Street will later buy. Once these companies mature and prove themselves to be a successful business, big money comes and buys them at much higher prices from what they IPO'd from. Those are the long ride opportunities I'm looking for. I want to buy Tesla, Apple, and Amazon before they became these big names. I want to buy them as soon as they hit the markets at the lowest price possible. The one big risk is that some of these high growth companies will not make it in the long run, and that's a gamble. I'm looking for these obscure opportunities. Now, we compare my outlook to that of the mega cap value stock investor, which, by the way, he has over $200,000 invested on all the big names and diversified with tens if not hundreds of stocks. He is secured with constant yearly returns and making decent dividends. It's super safe, not volatile. Unfortunately, once again, that is considered a small account. Every investor is different and not everyone can withstand volatility. In this market, there's plenty of ways to skin the cat, and there isn't one best way, only the best way that works for you. The Value Investor YouTuber failed to point out these differences in his video, and I think it was unfortunate. In my opinion, if you don't have at least $1.5 million, you're better off investing on high growth stocks unless you're extremely conservative and cannot withstand volatility. Then it makes total sense. I only say at least $1.5 million because at $1.5 million, you can invest that money into a 3% dividend stock and make $45,000 of yearly income to live off of. If you are safe and extremely cautious, then yes, it makes sense to buy companies like Apple, Google, Amazon, and Microsoft with a small account. I also see a big mistake new investors make. What do most new investors do? They want to buy the same large cap companies that the big institutions buy. They usually have a very small account and buy Apple thinking they're going to get rich since someone like Warren Buffett owns the stock, so they will be rich just like him. But, however, Warren Buffett is not rich in the sense that an average person might perceive. He represents enormous wealth and massive resources. As mentioned in the earlier video, Warren Buffett says that the curve of expected returns lowers dramatically as you make more money. Wealthy people and big institutions have to buy these mega cap value proven businesses to preserve their wealth. They cannot risk their capital in small, unproven businesses, only allowing them to buy the same selective stocks that they all own. They also do not buy smaller companies because they can literally be the majority share owners of the companies overnight or outright buy some of these companies, in which does happen from time to time. Us as small retail investors have the luxury to not live within the box of buying only the mega cap stocks. We have the freedom and potential to find the next 10x opportunities. This is why sometimes buying something for the simple reason that a large institution bought into is not always the best idea or the only choice. Every situation is contingent upon the account size and investing expectations. To summarize this video, the value investor YouTuber with the over $200,000 investing account is not wrong. He is very satisfied and happy with his yearly returns, and that works for him. I'd say where he went wrong was in bashing high growth stocks and not explaining the pros and cons of both investing outlooks. I prefer to invest in high risk, high reward at this time. And once I have a substantial amount of money, I will most likely change my investing strategy at that point. Even though I prefer high growth stocks, I still do sometimes buy value stocks from time to time. You can also diversify a portfolio by buying into both small and large cap stocks to have some balance. It's all contingent to your expectations and tolerance. This game is extremely dynamic, and I hate to be the bearer of bad news, but there is never a plain vanilla answer to such broad questions. Everything is always changing and circumstantial, much like the market. I hope this video brought some light into your investing journey and that you are now able to look at both sides of this never-ending battle between growth and value and choose what's best for you based on your investing goals and expectations.